Hey Michael, how are you?
I'm good. How you doing, Michelle?
I'm great. I'm great. So yeah, today I just wanted to do a little recap on the lending aspect of the real estate market. Today I have with me Michael Abram with Cros Country Mortgage and amazing mortgage broker. We've been doing business together for many years, and you also do loans for several of other realtors that I'm familiar with, and I know you always do a great job. So. Yeah, first of all, let me ask you, how was your summer? And I don't necessarily mean personally because we just talked about that offline, but wanted to know how was your summer business-wise? How was the market during these months of summer?
Yeah, it's been picking up. I must say, there's been more mortgage applications coming in. A little bit of a surge there at the tail end of the summer between late July into August.
Okay.
People kind of ramping up.
Okay, that's good. That's good to hear.
Yeah,
So obviously the big news is the half a point prime rate decrease that we just heard from the Fed, and wanted to know, what your thoughts were about that. What is the impact currently on the market, and where are the rates now, and how is it affecting the current market?
sure. So first off, interest rates have been coming down over the last couple of weeks in
Right.
anticipation of that meeting. And that was simply because we had an idea that Powell was going to lower the rates. So the banks already started pricing interest rates to come down leading into that meeting. So when we have an
Interesting.
event like that where they validate what we think they're going to do, it's a non-event in our book. So it doesn't change the rates dramatically. It's not like you see a surge of dropping in interest rates
Right.
going up or down because it was what we anticipated.
It was
What
already
that,
built in.
yeah, exactly. So what that did impact for immediate sources would be short-term loans, things that
Okay.
could be like car loans, car leases, credit cards that usually have higher interest rates, and you touched on it, home equity lines with the prime rate. So those are kind of the three biggest things that get impacted immediately with
Okay.
this cut in the interest rates.
Okay. Great. Great. And so where are those rates now? And of course, I know it depends on, what kind of loan, what kind of product, somebody would take out. But generally, where do you see the rates right now, like on a 30-year conventional loan?
So they're hovering closer to about 6.375. Fannie and Freddie will probably say it's closer to about
And by the way, just
6.1%.
make sure that we understand Fannie and Freddie are not your cousins. It's Fannie Mae and Freddie Mac, right?
Fannie Mae and Freddie Mac, yes. So they are going to publish a little bit lower on the average because they're just looking at the number of applications coming in and what the data is showing them. But
Uh-huh.
the average 30-year fixed rates are going to be a little bit higher, about 6.375, give or take the product, the loan product that
Right.
somebody.
Well, that's great news. I mean, it's
Yeah,
it's it's almost 1.5%, if not more, lower than what we had a few months back.
yeah,
So
absolutely.
yeah, yeah, yeah. So have you seen a surge of people calling you whether to buy or whether to refinance, or are people still waiting for further dips in the interest rates?
It's a little bit of both. I mean, well, on the refinance end, it's always kind of a game of when is the right time to strike. So
Right.
we're certainly looking at it from the perspective of what is somebody's current rate and where's the benefit? Is there a benefit now? Should they strike now? Or do we need to wait a little bit more? It simply just comes down to the math of what's the cost involved and what are the monthly savings. On the buyer side, there's definitely a surge of people that are trying to get back into this. They've been sidelined for a couple of years now because the cost of credit was a lot higher. So
Right.
a lot of them are revisiting their applications to
Sure.
see, where this drop is potentially going to take them in purchase power, and will it get them back into the range that they're aiming for, that they were hoping for during COVID level interest rates.
Right, right. Okay, well that's good information. And I think, that's on the lending side, and on the real estate side, which of course they're both, very, very, very connected. I think that our biggest problem on the real estate side for the past year at least, if not more, the lack of inventory was the biggest problem. And one of the main reasons that all the experts are quoting is the fact that people who were interested in selling, whether because they wanted to downsize or upsize, were very, very attached to their extremely low rates that they received during COVID, somewhere around the 3.5 or 3%. And they didn't want to let go of those rates to buy something else because they didn't want to go from like a 3.5% to a 7.5%. And so now we're hoping that as the rates go down, these people will eventually get off the fence and start putting their homes on the market to buy something else. Of course, there's always, something has to give. And on the other side of the fence of that is that now that interest rates are lower, more buyers are coming into the market. It means more competition. It also means that they're able to afford more, right? Because interest rates are lower. I assume when you qualify people, they can afford more money, and therefore sellers are going to say, well, if buyers can afford more money, I can ask for more money for my house. So we're probably not going to see real estate prices go down anytime soon because the interest rates have come down.
Right. It's kind of a controlled drop. That's what is going to happen here. So they've been increasing and increasing for years, and this first dip is a big one. It's what we needed, but it's like you said, it's going to drive more buyers, which will drive value up again. So the Fed is going to be really careful on this because they're concerned about inflation. That's what this has been about. It's been about pushing inflation down. It's not something that can be tamed overnight. It takes a long time to push everything to a level that they're comfortable with and finding like a right balance of everything in the economy.
Okay, so I think you kind of like touched on what I was going to ask you next is what do you foresee? And it sounds like the Fed's going to be like really, people shouldn't expect like, at the next meeting, rates are going to go down by another 0.5 point. Probably not, right? I mean, it's going to.
So it's interesting because the market reacted the other day thinking that rates actually went up. If you look at the rates from the other day, they went up a little bit. And the reason they went up, even though we had this dip in the federal funds rate, is because the banks thought they were going to be more aggressive and say the next couple of meetings they were going to continue about a 0.5 point cut for the next couple of meetings. And they didn't indicate that. They indicated they were going to be a little more conservative and probably do about 0.25%. So because of that, the rates went the opposite direction, went up a little bit. Not a ton, but a little bit. And so I think that overall, though, you will see, you will always have a spike in the interest rates. It can go up, it can go down. But I think the overall trend of what you are going to see is that rates will come down, probably stay in the 5% range. But especially Fannie Mae is projecting that they think the average will be about 5.7% in 2025.
In 2025. Okay, well, that's great, and we're definitely going to hold you to it. No, I'm kidding. We're not going to hold you to it, but it sounds like it's a pretty fair prediction. But I think what's really interesting that's coming out of this, what you just said, is that there's one thing which is the Fed lowering the rates, but there's also the bank saying, okay, sure, you lowered the rates, or we're predicting this or that, but we're going to do what we want to preserve our financial solidity by adjusting the rates the way they think they should be, even though the prime rates might have gone down.
Right. Yeah, banks are going to take a little more conservative approach because what people don't understand is there's usually a runoff of people that are trying to refinance. So there's a lot of cost involved for buying and selling mortgages back and forth. So banks are going to be careful on how they're pricing their interest rates because they don't want a huge slew of loans being sold off very quickly and then causing banks to go out of business because they're issuing penalties back and forth to each other. So it's a gradual process on the interest rates coming down.
Absolutely. All right, Michael. Well, I think that's a really nice, concise overview of the effect of the recent lowering of the interest rates. Really appreciate your insights. And as always, I recommend my clients or anyone who's interested in either buying or refinancing, give Michael a call. The information is down here, and you can contact him. And of course, if you have any questions about real estate, feel free to reach out to me. Be happy to answer any questions you may have. Michael, as always, thanks for the interaction here. Thanks for the video, and we'll be in touch soon. Take care.
Anytime, Michel. Take care.